Today we are analyzing Flowserve Corporation, ticker FLS. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, the company has a market cap of $4.7 billion, enterprise value of $5.6 billion. So you see about $900 million in net debt on this business. Not a significant amount, maybe about 15%, 20% of the overall enterprise value. Operating in the machinery industry, let's look at their business description. They develop, manufacture, distribute, and service industrial flow management equipment in the United States, Europe, Middle East, Africa, Asia, and internationally. So basically the whole world. Two segments. They have a Flowserve pump division, a flow control division. FPD division offers some custom and pre-configured pump system, mechanical seals, auxiliary system replacement parts, upgrades, etc. The FCD segment provides engineered industrial valve and automation solutions, isolation control valves, actuation controls, related pieces of equipment. So these are highly technical pieces of equipment, and they are providing the machinery, the actual manufacturing and design of this equipment. These are probably relatively high-cost pieces of equipment compared to the material cost. So I would expect to see some pretty good returns through that. But we'll see, depending upon, of course, what they're able to charge. So they are headquartered in Texas, beta of 1.61. That's actually a particularly high beta for an S&P 500 company. Means they're about 61% more volatile than the average stock in the S&P 500. Tends to be a sign of a lower quality business, but we'll see if that plays out in the rest of my analysis. When we look at the return on invested capital here, we can see that they have what looks like 20 straight years of profitability. That's always an immediately good sign that they are a quality business because they've avoided having losses. Also, you don't see cyclicality in this business. Now, certainly you see that they've gone up in return on invested capital, and then they've trended down since 2009. But you don't see this like business cycle type cyclicality. It wasn't like they bottomed out in 2007, 2009. That actually is a peak for them. And they didn't like bottom out during the recession in 2020. This isn't, business cycles every 5 to 6 years. They do have fluctuation. It's not slow and steady. It does mean it's relatively hard to predict, but you're not talking about business cycles. From a year-to-year standpoint, it does look like they have fairly good reliability, at least for the 2010 to 2014 time. They had pretty stable returns here. Now, it did decline after that, so it does make me wonder about acquisitions, something along those lines, because their returns have worsened since 2014. If I had reviewed this company in 2014, I'd be like, hey, look, this company is doing really, really well, very, very stable. Unfortunately, they fell off after that, and they've had poor returns since then, not getting above 10% since the 2014 time frame. So that is one concern. Now, when we look at a 10-year period, we see return on invested capital of 5.7%, return on equity of 11%. These numbers are below what I'd be looking for an investment. I'd really like return on invested capital in the double digits, return on equity about 15%, and I believe those two numbers combined together really help me get the double-digit returns that I'm looking for. I'm a little bit surprised about the gross profit margin at 31%. That's relatively low compared to how I thought this business might work out. I was thinking something closer to the 50% range would make sense. So the margins are not as good as I would expect, and the free cash flow is a little low. Nothing wrong with those numbers. You can turn these numbers into high returns on capital, but they're not doing that from what I see here. Now, you start to get very concerned when you look at the PE ratio. PE of 56 is astronomical. So we're going to have to do an analysis of what's driving that high PE ratio, because PE of 56 is just not worth paying for almost any business, no matter how fast growing. And when we look at the growth numbers here, not only are they not fast growing, they are declining in revenue across the decade, and they've had declining EPS across the decade, which is very poor. You would not want to pay a PE of 56 for a business with these results. So my immediate thought is that this company is both overvalued and probably like an average business. So we're looking at an average business that's overvalued, not a good sign so far. Now, I do want to know, because they've had revenue growth, is this kind of like up and down? Well, what's their highest growth year? Is it 5%? So their highest positive growth year was 5%, and that was 2012. Since they started declining in 2014, what's their highest growth year? 4.8% in 2018. But they had 4 years in a row of declines, which is actually quite poor. 2 years in a row of declines in the last couple of years. So this is a very unpredictable business, but overall we've gone from $4.7 billion in revenue to $3.5 billion in revenue, which is not a good setup. So the most recent year is actually the worst performing year on record. The gross profit has declined by a third, from $1.5 billion to $1 billion. Operating profit is down. It looks like over 50%, from $659 million to $253 million. That's very poor results. And earnings per share, it looks like, is down almost 2/3 from 284 to 99.6 cents. So I don't invest in declining companies. So I'm immediately thinking massive red flags about the potential for the future because the returns here have been so bad. Now, some people really like turnaround stocks. That's not really my forte. I don't think turnaround stocks are highly predictable and how you can manage that in the future. You've seen a decline in the operating margin here has gone down by 50% with only a 3% drop in your gross profit margin. That's a major concern because it means any further drop in the gross profit margin could really just destroy the whole economics of the business. I don't like seeing that. Dividends per share, they're still paying a really high dividend, 80 cents per share, but they're 96 cents on earnings per share. I don't like seeing this. I don't like seeing that the company is raising their dividend when their company's profits are collapsing. Like, why did they raise their dividend in 2020 from 2019 when they lost this much in earnings? This makes no sense. The capital allocation here is just really concerning. Now, if you say, hey, this business is going in perpetual decline, there's nowhere for us to invest our earnings, all we should do is just pay back our earnings to shareholders, fine. That can make sense. That might be the smart decision from a shareholder, maximization policy. I just have concerns about like how sustainable this is in the future, how quickly this EPS might drop below dividends per share in the coming years. Now, one thing that's interesting, it says PE of 56, but we're seeing about $1 in earnings per share in 2020 and 2021, which would mean that the PE should only be about 36. So it does mean that probably it's declined even worse in the 2020 numbers. Hopefully we'll see that in the next pages. If you're learning something from this video, please hit that like button. You don't have to like the stock to hit the like button. It's just telling YouTube that you like my content. So please hit that like button. I would really appreciate this. I think there's a lot to learn, even in the companies that aren't trending towards my watch list. So I hope you'll continue along with me here. We can see the shares outstanding have declined over time, but it's not been that much. It looked like they declined from 2012 to 2015 when they were making a lot of money, and then after that, they basically stopped buybacks, and they've been stable since 2016. What I like about this is you're not seeing dilution, so it's not getting worse, but they have stopped buybacks, and that kind of makes sense because now they're using all their free cash flow for dividends. That's okay. Not ideal or whatever, but that's okay. Now, you do see this, fall off in the trailing 12 months. Revenue is getting even worse. Cost of goods sold is going up. SG&A is going up. And all of that's declining, creating a situation where the net income is now lower than your past dividend yield. So this is the real crossover point where you start to get concerned. How are they going to manage this going forward? Could this company be heading towards something like a bankruptcy? Once you start seeing numbers like this, it starts to get really concerning. They're going to have to probably cut the dividend. Not that, they have a positive operating profit. There's no reason for any sort of bankruptcy or anything like that. But you just have to get concerned. Anytime revenue is declining, it just becomes a harder to manage business. That's all it means. Harder to manage. It starts to require cuts and things like that from the management side. It gets very difficult. Now, from the balance sheet, your PP&E has gone up in the decade, of course, even though your revenue has been declining. That's a little bit of a concern, but really when you want to look at debt, you've tripled your debt. And see, this is where I get concerned. You've had to raise debt, even though your earnings are getting worse and worse and worse. That's showing some deterioration in the underlying business. It's where I get concerned about paying out all your money in dividends. I'd rather you not have raised that debt during a period of declining earnings. Because it starts to come into question. That's where you start adding more and more risk to the business. We don't need to leverage up a business when you're declining. Leveraging up to grow can make sense, but declining really becomes a risk. Cash flow statement. Why is there stock-based compensation in a machining business? I don't know. I really don't think it should be in any business. I understand why it's in a lot of tech industry businesses, but I don't know why you're paying stock-based compensation in a machining business. You can see that they had those buybacks in 2015. It looks like they tried to do a little bit in 2019, 2021. I mean, if this is all you're going to do, why even do it at all? You see these dividends increasing. Now, the dividends haven't increased past the cash flow from operations, but they are approaching the net income number. Depreciation's kind of keeping them above water there. I don't know. I mean, the problem with this is what I call like an average stock. I mean, average stock has a lot of problems. Average stock has some bright spots. It might actually be a below average stock when you start thinking about declining businesses. Declining businesses are totally uninteresting to me. I think for those who specialize in them, they can be a great area of interest. Certainly you could make a lot of money buying a declining business if the PE was like 5 or less. But a declining business at 56 times earnings or 36 times earnings or whatever you want to call it is just way too high of a price for a company that is not at all appealing. So for me, I'm going to pass on Flowserve Corporation. I hope you learned something from this video. If you did, please hit that like button again. And you want to find the companies that I actually find really interesting, the playlist at the top here for my watch list stocks. Those are the ones that met my watch list. And although Flowserve hasn't, I think you will enjoy those videos next. So please check out the stocks on those watch lists. Some of them you've heard of, some of them you haven't. I think either way, there's some really interesting stuff. Please consider subscribing below as I work through every company in the S&P 500. And if you want to learn to analyze stocks quickly, eliminate stocks, quickly find stocks for your watch list, I enjoy using quickfs.net. My affiliate link is the first link in the description below. A great way to support the channel is to sign up for a free or paid account there and use my link so they know I sent you. Thank you for listening, and until next time, stop paying fees, start building wealth.